Investing is scary and confusing, so in this video, I'm going to give you a complete guide to investing to make things easy, simple, and stress-free, whilst also maximizing your returns. If you're sick and tired of all these other YouTube videos overcomplicating this topic and want a no-nonsense guide that will actually help you build generational wealth, then keep watching. And obviously, before we get into this video, I'm going to be sharing some very powerful strategies with you, but you need to remember this is not financial advice. What you do with your money is your decision, and you should consider talking to a financial advisor before you put your money anywhere, okay? Anyway, disclaimer out of the way, let's dive in. So many people on the internet love to overcomplicate the topic to confuse new investors, but it's pretty simple. At its core, investing is the action of putting money into a thing for a period of time in expectation of receiving a profit. So why would you want to invest in the first place? Well, for one, investments can help you combat the effects of inflation, because whenever you store money in a bank account, it's going to lose 2 to 3% of its value every single year. Money becomes worth less and less over time, and the value of a good investment will consistently keep up with inflation, helping you to retain the value of your money. Offsetting inflation is all well and good, but an informed investment will actually outpace inflation by a good margin, helping you to grow your money over time. So let's say that you invest in stock X, which has an annual return of 10% a year on average. This will mean that instead of losing or merely retaining its value, your money will actually grow by about 8% per year, factoring in inflation. So this is called capital gains, and it's how billionaires like Warren Buffett have built their wealth over time. Also, if you invest correctly, you can actually use your money to make money through something called a dividend. Basically, when a company makes a profit, it likes to reward investors for sticking by that company, so it will pay out a small portion of its profits to each and every investor. So theoretically, with enough invested, you could just live off dividend payments without having to actually work another day in your life. And this brings us to something that Einstein once labeled the seventh wonder of the world: compound interest. Compound interest is the process by which you start to earn interest on the interest of your savings investments. Let's say you invest $100 in year one and it grows by 10%. So at the start of year two, you've got $110 in that investment account. That means that the same 10% return will generate $11 in year two as you've begun earning interest on your interest. So over time, this will literally spiral out of control exponentially until you have more money than you thought was possible. Now, let me put the power of compound interest into perspective for you. So at age 83, Warren Buffett was worth $58.5 billion. Fast forward 9 years, and he's worth $109 billion. How? 2 words: compound interest. This might sound confusing so far. So for now, I just want you to imagine that an investment is almost like sending your cash to work each day. It'll go out and earn a little bit of money and bring it back to you, helping you to grow your wealth over time. So by now, you're probably thinking that investing has the potential to earn you a lot of money with very little effort on your side. And you'd be correct. So how can you get started, and what can you actually invest in? What should you invest in? The most common and popular investment you'll find is public liability companies. PLCs like Apple, Microsoft, McDonald's, etc. allow normal people like you and I to buy their shares. And a share is just a minuscule portion of the company. The shares that you buy will then increase or decrease in value depending on the projections of the company, and can be sold at any time. To help you visualize this, imagine that a company is a pie divided into 1,000 equal slices. Each slice is a share, and the more you own, the more control you have over the company. You can also invest your money into cryptocurrency, which has massively grown in popularity in recent years, as we all know. I mean, I remember in 2017, before it really blew up and became this really popular thing, I knew a guy who had $1 million in crypto. I'm not sure how much he had, but he had Bitcoin and Ethereum at the time, and it was worth $1 million already to him then. So it's pretty insane to think. I wish I had actually gotten into it back then instead, but not everyone everyone makes great investment decisions. So cryptocurrency such as Bitcoin is essentially a decentralized currency powered by a blockchain. So there's a finite amount, meaning it cannot succumb to inflation. However, crypto is a very volatile market, and if you're looking to get into investing, it's probably a good idea to get some investing experience under your belt before you dive into crypto. The final major form of investment is real estate. Real estate is a fancy term for property and is another incredible tool for building your wealth. Like a stock, the value of property generally increases over time, meaning that you can simply buy a property, hold it for a few years, and make a profit depending on what the markets are doing. You can also generate a monthly cash flow by renting said property out. However, real estate is a rich man's game. Unless you've got the time, money, and credit history to secure a mortgage, fund a down payment, and then actually deal with needy tenants, you'll probably want to stay away from real estate for the time being. So in this video, we're going to focus on stocks and shares simply because it's the easiest form of investment for anyone to get into and doesn't require as much knowledge, experience, or research as other forms of investment. The first method is to buy singular stocks. This basically means manually buying a fixed amount of shares in an individual company of your choosing. And when it comes to individual stock picking, most people think of big tech companies like Apple and Tesla. To buy singular stocks, you'll need to sign up to a trading platform like Trading 212 or Free Trade. It's really easy to open an account, and once you're in, you can search for the stocks that you'd like to buy. It's really honestly as simple as that. But the advantage of picking singular stocks is that you have complete control over where your money is going. You can also jump into big opportunities that may have unprecedented returns. Just think about Tesla, for example, right? In 2010, a share was worth $17. Now, you're looking at $186 a share. The second method is to invest in something called an index fund. If you've never heard about this before, don't worry, most people haven't. I'll try my best to break it down as simply as I can. An index fund is a big pile of stocks from markets like the S&P 500, and whenever you put money into an index fund, your funds are distributed across all of these companies proportionate to their share in the market. Instead of investing in a single company, you'll be investing in several hundred at a time. To invest directly in an index fund, you'll need to open an account with a dedicated provider such as Vanguard, which is the most popular one. From here, you can pick the index that works for you, and boom, you've just opened up an index fund. On average, an S&P 500 index fund grows by 10% per year and offers a dividend of 1 to 2%. Now, to be completely honest, I would always recommend that you go for option number 2 and just invest your money in an index fund. Why? Well, index fund investing has so many advantages over stock picking, especially for new investors. First of all, index fund investing requires pretty much no effort on your part. You don't have to research an individual company's balance sheet, profits, and all of that nonsense. You just have to pick a fund, chuck some money in your account, and let the magic of compound interest do its work. Secondly, index fund investing is a lot more risk averse than stock picking. So when you invest in an index fund, you're basically counting on the economy to prosper, which it always does over time. If one company fails, another will succeed, and everything will balance itself out. No one in history has lost money in an S&P 500 index after holding it for 30 years. The story is just not the same with stock picking. Putting all your eggs into one basket is so risky. What if the CEO of the company decides to quit and the company goes into disarray? What if a lawsuit ruins the company's image? What if, for example, a pandemic wipes out the need for the company's service, causing the share price to plummet? These scenarios might seem far-fetched, but all it takes is one wrong move, and you could lose all of your money by investing everything into a single company. Also, there are basically zero advantages of individual stock picking, honestly. Even expert stock pickers have been unable to beat the market with individual stock picking. Don't be fooled into thinking that you know better. All you need to do is put your money into an index fund, watch it grow every year, and retire early. So now that you know what to invest in, I want to share a few key investing principles with you that will make you a much more successful investor in the long term. First things first, you need to get into the market as soon as you can. Compound interest is a beautiful thing, and the more you take advantage of it, the better. Just look at how Buffett's wealth literally doubled in 9 years. thanks to the decades that had already been in the market. You also need to think long term. Contrary to what a lot of people on the internet may tell you, investing is a long game, and you're not going to become rich overnight investing. So broaden your expectations from years to decades, think about the future, and one day soon, you'll be thanking yourself. Bouncing off of this is the principle of investing little and often. You don't have to be a millionaire to get into investing. Instead, you just have to be willing to invest a small chunk of your paycheck each and every month, keeping your long-term goals in mind. Even if you're only investing $5 a month, it's going to give you discipline with your budget. And hey, I mean, it's better than, keeping that money in the bank anyway, losing it all to inflation over time. Be frugal if you have to, but make sure you're investing something whenever you can. You also want to be as risk averse as possible. Reducing risk is really the core of investing. So diversify your stock portfolio as best you can. Of course, the best way to do this is by investing in index funds, like I said, and minimizing the number of picked stocks in your portfolio. But you can also, look into other methods too, like branching into crypto and real estate. Another key principle is to buy the dip. So let me explain what I'm talking about, okay? When the market hits a recession, stock prices in general go down. The reasons for this are pretty complicated, and I won't bore you with all of that too much, but essentially, if the economy isn't doing well, neither is the stock market. Most people are terrified of a recession because essentially the value of their investments decrease significantly. I want you to view things differently. Think of recessions like a stock sale, where you can get more bang for your buck, essentially. Sure, past performance is no indicator of future results, but the market has always bounced back from a recession throughout history. And if you hold for the long term, you're almost certainly going to build wealth rather than lose it. It's also a good idea to build yourself a small emergency cash fund. Sometimes you need a little bit of liquid cash lying around just in case something unexpected pops up. So if you have all of your money in stocks, you run the risk of being forced to liquidate when the markets are down to pay, for example, for an emergency bill. It's a good idea to reduce this risk by keeping a little cash in the bank just in case something happens. Fingers crossed you'll never need it, but as I've said so far, investing is all about reducing risk and being ready for anything. Something really crucial as well, if you really want to take your knowledge to the next level, I've got a few book recommendations that you might find interesting. The first book to read is called The Intelligent Investor, and this book is infamous in the investing world and will teach you core principles and investing patterns to help you choose stocks and grow your wealth. To be honest though, it's a pretty dry read and it's also outdated at times, but if you can get through the dull tone, you're going to skyrocket your investing knowledge. Another title that I recommend to any investor is The Psychology of Money by Logan Housel. I'm probably butchering that name. This book is literally a gold mine for investing knowledge. It'll help you visualize just how rich you can become if you just invest little and often, and will also give you loads of useful tips on how you can actually manage your finances and ultimately put more aside each month for investments. I also want you to read The Life Lessons and Rules for Success by Warren Buffett. This book will give you a lifetime of knowledge and insight from the king of investing himself. And don't be scared about any, technical language. Warren is a very down-to-earth guy who really likes to make his knowledge accessible to the general audience. So let's say you've studied everything in this video, done your wider research, and have been investing in index funds for a while. What can you do next? I've got one word for you: diversify. Index funds are incredibly diverse in themselves, but there are ways to diversify your portfolio even further. Consider allocating a small percentage of your funds to crypto, say 5 or 10%. If you're younger, you might be able to afford a larger percentage than this, but always do your research before investing in any coin, as many people online promote pump and dump schemes, and if you play your cards right, you might just land a return of 10x or more. Next, you want to get yourself into the real estate market. I mean, sure, it's not going to be easy, but it's going to be worth it because real estate can give you monthly cash flow and a huge increase in net worth thanks to capital gains. So with a healthy chunk of real estate in your portfolio, you'll never need to worry about the stock market going down and vice versa. So again, let me repeat a few very crucial things when it comes to investing that you need to remember. Invest in an index fund. Invest now, little and often. Time in the market always beats timing the market. Set it and forget it. hold for the long term, diversify, diversify, diversify. Now listen, if you want to go deeper into how I personally make money online, check out the free training in the description below this video. But if you have any questions at all, comment below this video. I reply to all of my subscribers, so make sure you are subscribed. And don't forget to hit the like, share this video, whatever you like, if you want to get more content like this. And go over to this video and check it out if you want to go a bit deeper. I'll see you in the next video.